All right, guys, welcome back. Yesterday, we heard from Sean on different investment and retirement vehicles that you can use for your small business. We're going to continue that conversation today with the Roth versus traditional argument. I feel like it's the nonstop debate. People feel strongly one way or another for some reason. I'm going to tell you what I think as well during the course of the episode. But Sean, what should we be considering? We can't define the traditional versus Roth. If you could just refresh us on the core difference and just give us some insights on what you've heard between traditional and Roth, out there in the marketplace.
Yeah, this is a great topic. And by the way, I want to step back and say it is a really good thing to have significant amounts of money in retirement accounts, whether they're traditional, whether they're Roth, or whether they're both, right? There's no shame in, I built up a big Roth IRA or traditional 401k. So just keep that in mind, right? Now let's step back and say, well, what is a traditional? What's a Roth? And then I'll give you some insights in terms of my favorite approach for most Americans. All right. A traditional retirement account stems from the notion that this is traditionally how retirement savings have been done in terms of what they call defined contribution, where you and your employer make contributions to the account. Traditional just means that we take a deduction on the way in, right? And that's sort of the benefit of like, hey, we need people to have incentive to not spend today, to save money for tomorrow. So the way we're going to do that is we're going to give you a little piece of candy today, a juicy tax deduction, which everybody loves, right? So the traditional is we get a tax deduction today, and then it grows, they call it tax deferred. So there's no tax while it's growing. And then when we take it out, it's taxable ordinary income. So it's subject to income tax. Okay, so that's the traditional model. In the 90s, the late 90s, they introduced the Roth model, which is essentially just the flip of the traditional model. So we put money into a retirement account. We get no tax deduction for that. Okay. But then the money grows tax free. And then when we take it out, assuming we've met the conditions, which are pretty easy to meet, we get it out tax free. So it's the flip of the traditional model. The Roth model is tax free growth. We like that. So then where do we arrive in terms of which one should we be doing? Understanding they're not mutually exclusive, right? Which one should we be doing? And I noticed in 2023, there were some real big names in the personal finance space saying Roth 401k at work. You got to do Roth, you got to do Roth, you got to do Roth. And most of the time they start off with a decent predicate. The decent predicate is this. The federal government is, and it depends on when you're listening to this episode, but I've heard the number $34 trillion in debt. All right. So folks are worried, oh my goodness, in the future, retirees are going to pay a whole lot of additional income tax because of this incredible debt that the federal government has. I think that predicate is somewhat lacking in this sense. It starts with the correct fact. The government's in debt, and that's not a good thing. I don't want to get too political here, but I think most of us can agree, at least to some extent, that's not a good thing that we have 34 trillion of government debt. All right. So that means that there's going to be some combination in the future of tax hikes and or spending cuts. I don't believe it necessarily follows that retirees are going to pay a whole lot more in tax, right? I think there are plenty of Americans who could pay a whole lot more in tax that are not retirees. I look at lightly taxed university endowments. They could pay a lot more tax. A lot of investors, capital gains rates and qualified dividend income rates are historically very, very low. Those rates could go up. So I don't see this danger of retirees paying a lot more in taxes being that big of a danger, because I don't think it's guaranteed they're going to be taxed at higher rates, especially considering the number of retirees that vote. Okay, put that to the side. We have to think about, well, just how are retirees taxed in retirement? And how is the contribution tax deductible, right? So when we're working, we pay at a marginal rate. A lot of the people in the audience probably pay a 24% marginal rate, the last rate they pay on their income, right? The first rate's 10%. We have graduated tax rates, 10%, then 12%, then 22%, 24%. So a lot of the folks in the audience might get, put $10,000 into a traditional 401k, take the deduction, and maybe they pay at a 22% marginal rate. The deduction's at the marginal rate. So maybe they save $2,200 this year, 22% rate, $2,400 this year. All right. Well, what's it going to look like in retirement when they're taking that money out? You got to remember, you go up those progressive tax rates. First, there's a standard deduction that's quite sizable. Then there's a 10% rate, 12% rate, 22%. So it's this difference between marginal rate when you make the contribution versus effective rate when you're going back up the ladder. And so I did some analysis last year around, well, wait a minute, what's the effective rate going to look like on those distributions? And I find for many Americans, even relatively affluent Americans, the marginal rate is going to be in the high single digits, low to mid teens, because of going up those brackets again in retirement. It's like the system is set up to favor these deductions up front because of this effective rate phenomenon. And I even stress tested it. I increased some of those taxes, and I still found, with some pretty hefty tax increases, retirement accounts for most Americans tend to be very lightly taxed. Now, look, if it's a married couple, they're both high earning doctors, they built up 10 million in 401ks. Okay, they may be highly taxed. But I think for a lot of Americans, taking that deduction up front just makes a lot of sense. And I know, Shannon, there's a lot to unpack there, but my bias tends to be around just take those deductions when you're in your highest marginal rate.
Yeah, well, and there's always nuance to it, right? Which is take the deductions when you're going to get the biggest benefit out of it. But also, I also don't believe in this like all or nothing approach of that if I'm pro-traditional, I'm anti-Roth, or that if I'm pro-Roth, I'm anti-traditional. I don't believe in this like pro-vanilla, anti-chocolate. I go, I like twist cones or whatever. I like both. So can you just talk about how people can mix these strategies if they're not completely, let's say polarized one way or another in how they're saving for retirement, or just unclear or unsure?
Yeah. So two points there, at least. When we're working, we have a traditional 401k or a Roth 401k at work. Okay, great. And there's no income limit on that, right? We can be the quarterback for the Kansas City Chiefs, and we can max out our 401k, traditional or Roth, depends on what the Kansas City Chiefs offer, I guess. But okay. When we do a Roth 401k contribution, that's $1 that we can't deduct, right? Today, the limit, 2024, if we're under 50 years old, 23,000 in terms of employee contributions to our 401k. So if we put 23,000 in our Roth 401k. Okay, well, that's 23,000 we couldn't deduct, right? So I like optimizing for the trade-off. I tend to prefer for most Americans take the deduction today at work when we can get it. Okay, so that's 23,000 at work. Let's go to our home retirement account. When we're covered by a 401k at work, the ability to deduct a contribution to a traditional IRA is highly limited. Right? Many Americans who are covered by a 401k at work just cannot deduct a traditional IRA contribution. That applies to solo 401ks too, by the way. So if we can't deduct the traditional IRA contribution, why are we making it? Right? Non-deductible traditional IRA contribution by itself doesn't make a whole lot of sense in most cases by itself. So I think for many Americans, the play is what I refer to colloquially as dynamic duo planning. Let's do a Roth IRA at home, right? Where we're not sacrificing a tax deduction. We just don't qualify to deduct that contribution. So we build up some Roth assets at home. And then at work, where we generally qualify to deduct that because there's no income limit there, let's take the deduction. We're optimizing for the known trade-off. Where we are sacrificing a tax deduction, we don't. And where we can't get a tax deduction, we say, great, we're going to do a Roth, right? So that's one thing in terms of this traditional versus Roth, and can we mix and match? The second thing is this. Most of the folks in the audience are going to retire before they have to take, they call them required minimum distributions, which is a fancy way of saying the government says on these traditional retirement accounts, the party doesn't last forever. And for those born in 1960 or later, they don't have to take money out of those traditional retirement accounts until the age of 75. Okay. So what that means is you have this gap between retirement date and required minimum distribution date where you can do what they call Roth conversions, right? Roth conversions is just a great tactic. It's a great optionality play where you say, you know what? I'm retired. My income looks artificially low. You look at my tax return, it looks like I'm poor. I'm not. But my tax return, based on the way they just add up the numbers, looks like I'm poor. So what I'm going to do is, before I have to take these RMDs, these required minimum distributions, I'm going to do these Roth conversions. I like to say Roth at work is fine, but it ends the planning. Traditional at work, that might be the beginning of the planning, right? We're not limited to, well, we put the money in a traditional 401k. It's always going to live in a traditional 401k. No, right? Now we could just say, no, we're going to ride it out. We'll take it out in our retirement. We'll live off it. That's one play. Another play is, well, we're going to deduct today, let it grow in a traditional 401k. And then when we get retired, we're going to think about these things called Roth conversions, where what we're doing is we're affirmatively moving the money from the traditional to the Roth, and we're saying it's taxable, fully taxable, right? IRS, here it is, tax me on it. Well, why the heck would we voluntarily pay tax? Because we think we're in a low tax bracket, right? So traditional and Roth, it's not either or, and that's it. Like you're saying, we can do that swirl cone, right? And what we might do is we might say, well, I'm doing traditional today to set up Roth tomorrow, or at least some Roth tomorrow, because I think I'm going to be age 62, 63 and retired. My tax return says I'm poor. I'm not, but my tax return says I am. So I'm going to create income. I'm going to move the money from the traditional to the Roth when my tax rate is low. And I've played the game well because I deducted at 24%, 32%, 22%. And maybe I include it back in taxable income, maybe against the standard deduction, maybe at the 10% rate. And I'm essentially printing money off the government, and it's all perfectly legal. It's just the way the tax rules work. I don't make the rules, right? I just talk about them.
Well, I always say that to win the game, you have to learn the rule book. And yes, these are part of the rules. And one thing I always read is like, oh, it's a loophole. And I go, it's not really a loophole if it's written in the code. It's part of the rule book. It's part of the game. The fact that you just learn the rule, good on you, go apply it. But it's not a gap in the rule. It's actually in there that you can do this. And it's expected that you will. But I think that what you have to do is be savvy enough to know that, okay, here are my goals for retirement. Here's where I think I'm going to be, and actually plan ahead. And that's a really important step in the process, is understanding that yes, I always say that, analysis paralysis can get people with this stuff. They probably just heard you talk and they're like, I'm already overwhelmed at the different investments I can do and the different options I have and the different ways I can approach this and all this strategy. So it comes down to this. I think it starts with being really clear on what your goals are for retirement, what your goals are for how you want to save for retirement, what cash flow you have to invest. And then from there, it's just a matter of just ironing out how you're going to arrive at that goal. I just feel like there's a lot of reactionary behavior based on advice. Like you said, like, oh, you have to do a Roth 401k at work, or you have to do this. Like, these are people, it's like diet advice. It's like, sure, you could do that, but like, what are you trying to accomplish? And what does your actual money metabolism look like? Can you actually sustain that? How do you approach advice for people who are just really overwhelmed by all the options?
Yeah. And so you're going to see content out there that says, well, it's great you built up a 1 million, 2 million 401k. Guess what? The government owns 30%, 40% of that. Well, I ran through the numbers last year on my blog, and it's just not true, right? So what I find is the effective rate on those distributions from the traditional 401ks in retirement, even if we're relatively affluent, tends to be relatively low because, again, we're getting taxed against the 10% bracket, the 12% bracket, and so on. So what I'd say is this. One, most Americans are not going to have a tax problem in retirement. In fact, sufficiency tends to be a much bigger issue than tax. So if you're behind in the game, say you're listening to this and you say, boy, I just haven't built up my retirement accounts the way I know I should have. Well, okay, take the deductions, build up your traditional 401k. It's the quickest way to do it, right? Just through deductible contributions, because they're essentially cheaper than Roth contributions. Build up a big asset, and the odds are you'll never have a tax problem. And oh, by the way, if you do so well that you have a tax problem, guess what? You've done very well financially. So I'd say just fear is not a good thing here, right? Building up assets is very powerful, very impactful, and is only going to help you in the future. I just think that's where we're at on this. And, that said, like, look, I would not lose sleep over, those last $2,000, should that be traditional or Roth? Don't lose sleep over that. But if you're behind or if you're worried, building up traditional retirement accounts is a perfectly valid way. And the odds are you're going to do well in retirement and frankly, at any point in your financial journey, just to have built up those assets.
For sure. And speaking of building up assets, there's a commonly held belief now that's kind of developing that, there are some people who are actually anti-retirement accounts, anti-401k, anti-SEP IRA, anti all of it. And they're saying, just invest in yourself, invest in real estate, invest in your business, invest in other things that are more here and now. What is your take on that advice that we're hearing? And what do you recommend that people do when they hear stuff like that?
All right. So I'm not here to provide investment advice to any one individual in the audience, but I am here to say, you got to step back and you got to say, well, okay, let's say I'm a small business person, a solopreneur, small business, right? That's a highly undiversified part of my balance sheet. And it just is what it is, right? I can't do 25, 50 different industries. I don't have that bandwidth, right? So if I'm going to be highly concentrated and undiversified in one piece of my balance sheet, does it make sense to then find another piece of my balance sheet and be highly concentrated and undiversified there? Not particularly, into my mind, right? This is just my opinion, but I don't think it makes sense for most Americans to say, look, I'm going to be in one industry, even W-2 workers, right? I'm going to have one type of job depending on one industry. And yeah, there's some flexibility and I can go from A to B, but I can't go from A to Z, right? But okay, fine. So I like this idea of being relatively diversified. And I think the other thing you see out there is a lot of folks promoting specific industries, rental real estate, or industries / investments, rental real estate, annuities, index universal life, right? I think one thing about those is they generally increase volatility. They increase fees. That's a big one, right? Let's control for those things that we know, right? Fees is one of the few things that's relatively predictable, right? Investment returns. What's the stock market going to do this year, next year? What's the bond market going to do? Don't ask me, right? I'm not going to predict that, right? But fees, I can predict. I can take a look at an investment and say, this thing has had this level of fees the last couple of years. It might go up a little bit. It might go down a little bit, but that's going to be, the fees are relatively known. So I like controlling for that. And I tend to think a lot of these alternative investments solve for problems that we don't have. I'll give you just one example, annuities, right? So an annuity is a future income stream. All right. There's nothing wrong with a future income stream generally sold to you by an insurance company, and you need to live to keep collecting it, generally speaking, right? There's nothing wrong with an annuity. But if you're an American listening to this, the odds are you already own an annuity. What, I do? No, I don't. I just pulled my accounts the other day. Oh, yes, you do. It's called Social Security, right? Whatever you think about Social Security, it's an annuity. And you rarely see annuity people selling annuities saying, well, I know you already have one of these. You already have a big screen TV, but would you like a second one in your living room, right? That's what they should be saying. Now, every now and then it's the right answer, but you got to, I think there's a lot of incentive to sell some of these products without looking at the individual circumstances, right? And I just gave one there where, hey, annuities aren't necessarily a bad thing, but a lot of folks already got one. Do they really need a second?
Yeah, to your point about diversification, you want to have, there are plenty of entrepreneurs out there saying you want to have 7 different income streams. But I don't see a lot of people saying you want to have 7 different investment channels either. So you want to have the variety of income streams because you don't want to be over reliant on one particular income source. But I say, well, then why should that change when it comes to your retirement savings? Why would you also want to bet on one horse or on one square of the roulette wheel?
That's exactly right, Shannon. And, the other thing too is we live in basically the greatest era ever to be an investor. So I'll give you a little anecdote from my own family history. My understanding is my grandparents, who neither went to college, in the late 50s, one of them inherited a sum of money. It was something like $15,000. And they actually, one of the things they did with that money is they bought a small cottage out on the east end of Long Island, what's now called the Hamptons. So people might hear that and think I'm like a Rockefeller. No, what happened was they were working class folks. They came into some money. And what did you do when you came into some money in the late 1950s? You bought real estate. Because what were they going to do? They certainly weren't going to pull out their phone and set up an account on a brokerage firm in 10 minutes, right? And they didn't know any investment professionals. They didn't know any bankers, right? So consider my grandparents back in the late 50s versus today. If you inherited $150,000 today, Shannon, you could pull out your phone and invest in mutual funds that own a plethora, right? To use a fancy word, a plethora of businesses all over the world in all sorts of different industries. And the investment fees on that would be hardly anything. And in 10 minutes, you could have that invested to your heart's content or desire. And you'd have brokerage firms fighting over your business too, right? You don't like the app on firm A, you just go to firm B, and that could be enough of a differentiator. So the world has changed. So why are we trying to do these weird individual things to solve for our investment situation when today we live in the greatest time ever to be an American investor?
I totally agree. And I'm always an advocate for invest in what you know and understand. But one of the things, if you don't know or understand this world and you're really new to personal finance and new to investing, is to trust the market broadly and to diversify your investments to match what the market's doing, whether that be an index ETF or an index fund. Something as simple as that to start with can actually create the momentum on your personal finance journey, just to better understand what it is you're actually doing and develop that strategy. Sean, any other parting words of advice for our listeners when it comes to setting up a retirement account as a business owner?
Thanks so much, Shannon. The big takeaway I'd say is do not fear retirement accounts, particularly traditional retirement accounts, right? For most Americans, it's going to turn out that those retirement account distributions in retirement are relatively lightly taxed. And for the handful who suffer high taxes, guess what? You will have lost a battle, but you will have won the war, right? If you got $10 million in a traditional 401k, you're probably doing really good. And yeah, it'll stink to cut the IRS a big check, but otherwise you'll be enjoying, with a martini in the hot tub, and you could write the check from there, and your existence, your lived experience will still be pretty good. So don't fear retirement contributions, particularly don't fear traditional retirement account contributions.
I love it. Thank you so much for joining me today. I really appreciate it.
Thank you, Shannon.